In today's world, the structures that underpin our financial and legal systems are often hailed as pillars of stability and fairness. Yet, a closer examination reveals a troubling reality. These systems are frequently designed in ways that disproportionately benefit the rich and powerful, while leaving the rest of society to bear the brunt of inefficiencies and inequalities. This article explores how banking and legal systems are skewed in favor of the elite, the consequences of this imbalance, and what can be done to create a more equitable framework. The banking system, a tool for the wealthy? Banks are often seen as neutral intermediaries, facilitating the flow of money and credit in the economy. However, the reality is far more complex. The banking system, as it exists today, tends to favor those who already have wealth and power. Here's how. 1. Access to credit. Wealthy individuals and large corporations enjoy easier access to loans and credit facilities. They can provide collateral, demonstrate established credit histories, and are perceived as lower-risk borrowers. In contrast, small businesses and low-income individuals often struggle to secure loans, even when they have viable projects or urgent needs. This creates a cycle where the rich get richer, while others are left behind. 2. Bailouts and moral hazard. During financial crises, governments and central banks frequently step in to bail out large banks and corporations, arguing that they are too big to fail. This creates a moral hazard, where the wealthy are insulated from the consequences of their risky behavior, while ordinary taxpayers foot the bill. The 2008 financial crisis is a stark example of this dynamic. 3. Financialization and speculation. The financial sector has grown disproportionately large, often prioritizing short-term profits over long-term economic stability. Speculative investments, such as derivatives trading, benefit those with capital to invest, while contributing little to the real economy. This exacerbates inequality and undermines the stability of the financial system. 4. Regulatory capture. Wealthy individuals and corporations often influence banking regulations to serve their interests. Through lobbying and campaign contributions, they can shape policies that favor their bottom line, often at the expense of the broader public. This phenomenon, known as regulatory capture, undermines the effectiveness of oversight and perpetuates systemic inequities. The legal system. Justice for the elite? The legal system, which is supposed to uphold justice and fairness, is also riddled with biases that favor the rich and powerful. Here's how. 1. Cost of legal representation. High-quality legal representation is expensive, giving wealthier individuals and corporations a significant advantage in legal disputes. Those without resources often cannot afford to defend their rights effectively, leading to unequal outcomes in court. 2. Complexity of laws. Legal systems are often complex and difficult to navigate without specialized knowledge. This creates a barrier for ordinary people, while those with resources can hire experts to exploit loopholes or shape laws in their favor. 3. Influence on legislation. The rich and powerful often have disproportionate influence over the creation and interpretation of laws. Through lobbying, campaign contributions, and other means, they can shape legal frameworks to protect their interests. This undermines the democratic process and perpetuates systemic inequities. 4. Enforcement disparities. Laws are often enforced more rigorously against the poor and marginalized, while the wealthy can avoid consequences through settlements, delays, or other means. This double standard erodes trust in the legal system and reinforces existing inequalities. Consequences of systemic bias. The systemic biases in banking and legal systems have far-reaching consequences. Economic inequality. The concentration of wealth and power in the hands of a few exacerbates income and wealth inequality, leading to social and economic instability. Erosion of trust. When people perceive that the system is rigged in favor of the rich and powerful, it erodes trust in institutions, leading to political polarization and social unrest. Barriers to mobility. The systemic advantages enjoyed by the wealthy create barriers to upward mobility for others, perpetuating cycles of poverty and inequality. Loan as a product and loan default as overproduction. An insightful perspective on the banking system is to view loans as a product and loan defaults as a case of overproduction. Just as manufacturers produce goods, banks produce loans. When banks extend loans to borrowers who are unlikely to repay, it can be seen as overproduction of risk. This analogy highlights several key issues. 1. Risk management. Just as manufacturers must manage production levels to avoid excess inventory, banks must manage lending practices to avoid excessive risk. Overlending to high-risk borrowers is akin to overproducing goods that cannot be sold, leading to financial losses. 2. Marketing and external factors. Aggressive marketing of loans, often seen in subprime lending, cannot be excused by blaming external factors like economic downturns. Banks must account for these risks, just as manufacturers must consider market conditions when planning production. 3. Stakeholder impact. The failure of loans, defaults, affects not only the bank but also depositors, shareholders, and the broader economy. Similarly, overproduction in manufacturing impacts shareholders, employees, and customers. Both scenarios highlight the systemic nature of poor decision-making. 4. Adjustment and accountability. Just as manufacturers adjust production levels in response to market conditions, banks must adjust lending practices based on risk assessments. Failure to do so reflects poor management and accountability. This analogy underscores the need for banks to align their lending practices with sustainable demand, rather than prioritizing short-term profits at the expense of long-term stability. Conclusion: the banking and legal systems, as they exist today, are not neutral frameworks designed to serve the public good. Instead, they are often skewed in favor of the rich and powerful, perpetuating inequality and undermining trust in institutions. By recognizing these biases and advocating for reforms, we can work towards a more equitable system that truly serves the needs of all members of society. The road ahead is long, but the first step is acknowledging the problem and committing to change. The analogy of loans as a product and loan defaults as overproduction serves as a powerful reminder of the need for responsible practices in both banking and manufacturing, ensuring that the systems we rely on are fair, sustainable, and just.